Let's take a look at another exercise in which we're going to work on acquisition of various assets, and we also have a non-interest bearing note to work on a liability. So here we have a company that's purchased land as a factory site and contracted with Maxter Construction to construct a factory. They made the following expenditures relating to the acquisition of land, building, and equipment for the factory. So what we've done over here is we've set up into like a table: land, building, equipment, land improvements, expenses, and a forklift that is also purchased and other equipment. So let's go through each item and see which of these assets it needs to fall, it falls under the expenditure. So the purchase price of land is 1.2 million. Obviously that is land. So we can put that number up over here. Demolition and removal of old building. Anything you do to clear the land and get it ready for its intended use. Remember, we intend to build a factory. So that gets added to the cost of land, that $80,000. I also paid for clearing and grading the land before construction, which means that is also a cost of land, the $150,000. Then I paid various closing costs in connection with the acquisition of land. So that is also added to the cost of land. We paid architects for plans for the new building, $50,000. That's a building cost, $50,000 for building. We paid Maxter for construction for the building. That is obviously in the building, 3.25 million. We purchased equipment for 860,000. Obviously, that's an equipment cost. So I put that under equipment. I paid freight charges on equipment, 32,000. It's a one-time expense that was necessary because I purchased the equipment. So that gets added to the cost of the equipment. I purchased trees, plants, and other landscaping, $45,000. That is a land improvement. It's separate from land. Land improvement. I paid for installation of sprinkler systems for the landscaping. That is also land improvement. So I put that 5,000 over there. I paid for the cost to build a special platform and install wiring for the equipment. That's an equipment cost. So come back over here and add it to equipment, the $12,000. I paid for trial runs to ensure that the equipment is properly installed. One-time expense added to the cost of the equipment. I paid for fire and theft insurance on the factory for the first year of its use. This is a regular expense. It's not going to get capitalized. So I put that down under expenses. It's a regular insurance expense that I have. Then let's see what's given here at the bottom. In addition to the above expenditures, we purchased 4 forklifts from Caterpillar. In payment, we paid 16,000 in cash. So for the forklifts, 16,000 in cash. We also signed a non-interest bearing note requiring a payment of $70,000 in 1 year. The interest rate is 7% for this type of loan. It's a non-interest bearing note, which means the interest is included in it. I need to find out what the present value of $70,000 is. So here's what I would do. I write down $70,000. I look up the time value of money table, present value of a single sum. It's a 1-year note, so n equals 1. Interest rate is 7%. So we go with the present value of 70,000 multiplied by the risk-free rate of return, 7%. So present value factor, n equals 1, I equals 7%. The factor is 0.93458. I multiplied by $70,000 to come up with the present value. So let's start here from the last asset and work our way backwards. For the 4 forklifts, I paid 16 in cash. The note payable has a present value of 65,421. And so this asset is going to be debited 81,421. I add up these two numbers. I have only one expense over here, so I can just write that number down. Land improvements, the total is 50,000. Equipment, we add up the numbers to come up with a total of $911,000. Building, we have $3.3 million. And finally, for land, we have $1,472,000. So once again, doing a journal entry is easy once I know which assets those numbers need to be allocated to. Those dollar amounts that you're spending over there, you need to identify it. For land, it is purchase price plus all those necessary costs that you incur, expenses that you incur, expenditures in order to bring it to its useful condition. Any leveling, grading, demolition, whatever is done, any title fees, lawyers' fees, all of those that you pay, the legal fees gets added to the cost of land. So we need to be very careful to see which asset you're going to allocate it to, because remember, land never gets depreciated. Other assets such as building equipment, land improvements, these are going to get depreciated, but over their appropriate life and using the appropriate methods, depreciation methods, which you will study in the next chapter.